All right. Thanks everyone for coming. It's once again the Judge Accountants and Clarity Wealth Federal Budget Review. And I'm Dave Rosenthal, manager from Judge Accountants. And joining me today is Matthew Corrie, senior financial planner and partner of Clarity Wealth. Thanks for joining us, Matt.
Hey Dave, how you going?
I'm doing very well. How are you going today?
Good. Bit of a sniffles actually, but yeah.
That's all good. We're at a distance from each other, so we're good. So, and what a fantastic budget it was. Once again, it's funny having two budgets within a 6-month period, but here we are again. So we'll just jump straight to it. Before we begin, Matt, do you have any opening thoughts of how the budget was this year?
No. I mean, I suppose in the space that we work in, I think it was quite a good budget in the sense of, and we'll go through this a little bit later, trying to kind of actually improve on some previous initiatives as opposed to kind of announcing brand new ones, which is good.
Yeah, exactly. Look, I think a lot of the initiatives were sort of, it wasn't as much as probably say the last budget, which kind of normally, when it's normally the budget's a bit lighter than the last one, it's normally that they're thinking that the economy is doing well, we're on track. So it's sort of, I think the best way to put this budget is sort of, Australia is back, but asterisk conditions apply. So, obviously one of the big things from that is understanding that we're probably going to be like this for closed off from the rest of the world for at least another year, it looks like. And but more important, we'll sort of go through some of the major announcements through this today. So in our budget, we've got sort of 5 main sections we're going to cover off. We have superannuation, we have taxation, we have social security, aged care, and housing. So we'll go through each one and all the different measures sort of pulled out from that. We will take some questions. We'll have time for questions afterwards. So if I do believe we're doing a bit of Q&A through here, but you can also just hang on to them at the end and we can go through them all. So if you want to put your questions in the Q&A and we can go through them as towards the end. So without further ado, let's get straight into it and go through superannuation with Matt.
Yeah, so it wouldn't be a budget without there being some changes to superannuation. So it tends to be an area, obviously, as most pre-retirees or retirees know, it's an area that the government loves to tinker in. And thankfully, in summary, they've actually made some really, really good improvements and really look to kind of simplify the system, actually, which is really good. So one of the things, obviously, that we kind of highlighted there, it's a relaxing of the work test requirement. So essentially what they've done here is abolish the work test requirement for people aged between 67 to 74. So previously there was a requirement for essentially people to work 40 hours in a period over 30 days. Now, obviously that threshold wasn't quite high. That's part-time for 1 month. But what it essentially did was kind of create just a little bit of a layer of complication for people in contributing to super. But also kind of what it did as well is it pushed people who might have had kind of substantial assets that they were going to lean on for retirement to, namely property, to have to sell them and make those contributions. So really what this has done is it's given retirees an excellent amount of flexibility when it comes to contributing to super and contributing to super over a longer period of time. So, there's nothing but big ticks around an item like this, as it allows people to get superannuation in for a longer period of time and really kind of simplifies that system. One of the other things that they looked at again as well, and this probably feeds into a bit of that housing theme, is the eligibility for the downsize of super contributions. Now, it was an initiative that kind of came out for over 65s and enabled people to essentially, and downsizing is a bit of a confusing concept. The regulations don't actually require you to go out and buy a smaller house. It's just if you've got money left over, then you can utilize these downsizer super contributions. But essentially what that does is it enables you to use 2 caps or 2 abilities to put money into superannuation, that being the traditional means by just your normal contributions. But then they've also created this other cap as a result of selling, that becomes eligible as a result of selling your home, which is up to 300,000 per individual. So kind of what we're seeing here is I think they are trying to encourage downsizing as a pre-retirement strategy, not necessarily at retirement. But I suppose it does kind of feed into freeing up housing stock and things like that. The success of a strategy and an initiative like this, there will always be that caveat which I suppose deters people from utilizing this, which is taking money from your home and then possibly putting it into super or investing or whatever it might be. Can possibly affect Centrelink benefits down the track. So not that we got much feedback from the government regarding that being the big inhibitor for this kind of strategy, but nonetheless, it does open up a really good opportunity for people that, that people do have a lot of wealth tied up in their house and want to make real substantial contributions to superannuation. If we go forward, I suppose this is more relevant to to workers and probably business owners, but what it does is it removes that $450 per month superannuation guarantee income threshold. So essentially, obviously, you have to earn more than $450 per month in order to be eligible for superannuation contributions. Really what this comes from is them really wanting to get kind of lower income workers contributing to the superannuation system. And as we've kind of seen through the media, there's been that women theme, and around, I think they mentioned around 66% of the cohort that would benefit from this strategy is women. So again, it's one of those things that simplifies the system and does create benefits for other people, which is good.
I think one of the key things to make a note of that, and that's for a lot of our a lot of businesses out there, is obviously there's another year for it, but what you'll probably notice is that software systems which will need to be updated to factor this in, because obviously most payroll systems will automatically calculate that if you make less than $450 a month, there's no super on top of that. So I would imagine once this gets passed, all software programs will be updated to factor that in, so everyone still stays compliant with single touch payroll and any other business requirements.
So another thing, obviously, for first home buyers, which I mean is probably relevant for a lot of people, given that the bank of mum and dad's become one of the biggest lenders in the country, is the ability for people to contribute more of their savings into superannuation, and within that environment to save for a purchase going forward. So essentially, they've just increased the threshold from 30,000 to 50,000 in that case. Another thing, again, this is quite an archaic rule that they use. It didn't really reflect where people are at or how kind of the global economy works, but essentially they're just relaxing residency requirements for people that operate self-managed super funds. So traditionally people that went overseas would have to have central management control within Australia, and that might be via an accountant or via a power of attorney. Essentially, they've extended that time frame, for people to appoint that individual. And what that really does, it's just reflecting the fact that obviously people travel overseas a lot more now for work, and they want to receive, they don't want to create that impost and force people to shut down self-managed super funds just because of the fact that they're going overseas for a short amount of time. So I might flick over to Dave at this point, and he can take you through some of the exciting areas of taxation, and some of the changes will be occurring there.
Because taxation is always an exciting thing, isn't it? Everyone loves taxation. Or is it just me? All right. So from a taxation point, it really is a steady as she goes budget. Basically, a lot of the measures have really been more of extended. There's not too much anything brand new, but we'll go through everything in detail anyway. So first off, we've got the retention of the low and middle income tax offset. And this has been extended a couple of years now. Those who don't know, the low to middle income tax offset came in when the government brought in their three-stage tax plan. So the low to middle income tax offset was actually one of the first parts. It was in stage 1 of the tax plan, and it was supposed to actually be phased out with the stage 2 tax cuts. Unfortunately, I think now it is a bit politically unpalatable to be getting rid of this, as basically most people will announce that it's a extra tax penalty for low to middle income workers now. So this has been renewed for a second year, and I imagine it's probably going to be renewed in perpetuity or for the foreseeable future. But essentially, the low to middle income tax offset is a $1,080 tax offset for basically for incomes between $48,000 and $90,000. And then once you're over $90,000, it phases out until you reach $126,000. And then there's just no tax offset altogether. Now, with this tax offset, it comes in the tax return at the end of the year. So this is where people normally get a bit of a larger refund for the last few years. It's predominantly because of this low to middle income tax offset. Then the next two big measures, which was announced at the last budget, but they've now actually been extended. So the temporary full expensing extended to 30 June 2023. What this is the extension of the instant asset write-off, which is now unlimited. Now, the instant asset write-off is when essentially if you buy an asset, instead of having to claim depreciation over multiple years, you can claim the deduction for the cost in one go in the year in question. And for until 2023, you can buy whatever you want at whatever price. So if you felt like buying $1 million piece of equipment for your business, well, you're going to be getting $1 million deduction. So that's a pretty good measure there. So that is now one of the key things with this full expensing is in order to get the deduction, it has to be fully installed and ready for use in the question. So you can't order it, then claim a deduction and while you're waiting 3 months for the machinery to come in. So I know there are probably a lot of people right now who've got machinery on order, and there's a bit of a backlog right now, just obviously due to supply chain and COVID. So that's one of the key requirements. But because we've got another couple of years to do it, that I think is going to be seeing a lot more investment over the coming years. And then that works in conjunction with the second measure being the temporary loss carryback. Now, the temporary loss carryback has also been extended to the 2023 year. And what this measure is generally when you make a loss in a company or a loss in a company, you can only use it in future. So for future income. So it carries forward. For this specific measure, actually, you can use a current year loss on prior year tax bills. So if you paid tax in the 2019 year or even 2020, and if you made a loss this year, you can use that loss and get back some of the tax you've already paid. So it's quite an advantage, and both measures actually work hand in hand because put it in practice. Say this year you decide to buy a brand new car or a brand new piece of equipment which generated a loss in your company. You can actually use that loss to get back some of the tax you paid in prior years. And this is something which the ATO is openly discussed and actually agrees with it as well. That's part, if you actually look in the practice papers with the ATO, they encourage that sort of method to use both measures hand in hand. So then moving along, we've got basically some tweaking in regards to treatment of employee share schemes. Employee share schemes is basically schemes where instead of getting cash remuneration for your work will actually give you shares in a business. They're quite typical in, say, businesses such as larger ASX listed companies such as Qantas or BHP. You might get a salary and then obviously some shares. Those shares will have a determined income value, which you declare in your tax return year on year. Basically, this measure a few years ago, the employee share schemes, they tweaked the rules to allow a bit more streamline. So previously, in order to calculate the share schemes, it was quite a complex calculation. So it was normally only left for larger companies to use them and utilize them, but they streamlined the process a bit more to try and entice more sort of startup startup companies. And so now they're basically helping with those startup companies in the phases in regards to share schemes. So generally, when you receive shares, you'd be taxed on them if you quit your employment. So what they're doing is they're removing that obligation, saying that even if you leave your job and you receive these shares as part of remuneration, you won't get taxed on it straight away. You might get taxed at a later date. So, and then also they're reducing some regulatory burden because obviously, as I said before, it's a lot of administration involved in managing these schemes. So they're trying to streamline that. Moving along on our tax matters, we've got modernizing tax residency for individuals. Now, obviously, not many of us are leaving the country right now, so there's not too much issues with residency, but you probably get a lot of expats coming back home. And generally, in regards to being a resident for tax purposes, it used to be quite a complicated and convoluted test. There was what's called right now, if you wanted to be tested for tax residency, you would have what's called the resides test. In this test, they're basically looking of, have you actually set up a life here? Have you made effort to establish life in it? So, have you got a rental property? Have you got a gym membership? Are you contributing to the community, or are you just living in and out? And so it was a bit hard, and there was always a lot of discrepancies and disputes regarding residency. So now they want to bring in just a very simple 183-day test. So basically, if you're here for 183 days, you're just a tax resident, no matter what the treatment is. So 183 days in a year, so 6 months. So they want to bring that in. And then the other measure is in regards to simplifying self-education expense deductions. So obviously self-education deductions, so expenses incurred for, re-educating yourself to, as part of your work, or, to improve your current employment. Currently, the first $250 is actually not deductible. So generally, whatever you're claiming, you got to take $250 off. They're going to basically remove that, so you're able to claim a deduction from $1, which I think is basically makes a lot more sense and helps a lot of people retrain and relearn going on, and that's one of the big pushes with obviously the job trainer program and other measures they've brought out. Moving along, this is the standard indexing of Medicare levy thresholds. So this increases year on year. So basically the current level of income you need to earn before you're liable to pay Medicare levy. So that's increased basically around CPI level, around sort of inflation levels. And that's just the standard yearly update. And then finally, we've got extension of the fee help loan fee exemption. So fee help is, for those over the age of 30, is essentially what HECS used to be. So obviously we all used to be on HECS when we were back at uni. Fee help is extension of HECS, or help as it's now called. And fee help is in regards to government loans for private colleges. So anything which isn't government supported, so private college management, falls under fee help. And there's an additional fee on top of the loan. So you actually have to, so there's actually a fee of equivalent to about 20% of the loan. So if you had a course for $10,000 for your MBA, you'd have to pay an additional $2,000 fee. So basically they waived that fee during COVID, and they've extended that as well. So just to encourage people to continue studying. So it kind of goes in line with the self-education expenses and with job trainer as well. And that's really all the major announcements in regards to taxation. So we'll jump into our next phase, which is in regards to Social Security. So one of the big announcements, which was obviously leaked well before the budget, was in regards to the increase of the childcare subsidy. So this is obviously not till July 2022, but childcare subsidies paid to approved childcare providers is going to increase. But it's really only going to increase for families with multiple children in childcare. So the childcare subsidy will still stay the same for the first child, which is childcare subsidy payable up to 85% of childcare fees. But for the second child, the childcare subsidy will be a maximum of 95%. So, and each subsequent child in childcare after that, 95% of their fees will be covered. And that's obviously, remember, 95% of the government rate of childcare. So the government rate of childcare right now works out to roughly about $120, $130 a day. They will pay a rebate of that amount. So obviously, if your childcare is a bit more, and if you're basically, within a 15-kilometer radius of the city, most daycares around there go into the $190 to $200 a day. So obviously, you're not getting a full rebate of that. And so basically, we move over to the next table, you can see the real dollar difference with the current subsidy and the new subsidy. So for families are making around $80,000 a year with the new childcare subsidy, and this is obviously for maybe an extra child in, they'll be about $53 a week better off. But that saving goes higher and higher as the income goes higher and higher. So a family on $180,000 a year, they'll be basically $125 a week better off, which is quite a good saving for that. But that's not coming in for obviously till 1 July 2022. Other than that, under Social Security, we've got improvements to the pension loan scheme. I might put this over to Matt, who's our expert in regards to pensions. So Matt, you want to explain a little bit more about this update?
Yeah, sure, Dave. So this was, interesting. The pension loan scheme's really kind of one of those underutilized parts of the pension system that people aren't really aware of, or it's not really advertised that much. And I think this is really, this kind of initiative is really trying to ramp up the amount of people that actually do utilize the pension loan scheme. Traditionally, the pension loan scheme worked in a way that you were able to increase your pension through increased pension payments, essentially with a loan from the government. Now, obviously, what they've realised now is they want to give more flexibility to this system and provide people with the ability to receive this as a lump sum and not just as a kind of regular payment within their fortnightly payment. So, essentially it says there from July 22, clients will be able to access lump sum advance payments, up to 50% of the full annual age pension. Again, depending on how much age pension you're receiving, will kind of dictate your eligibility for the pension loan scheme and how much you can top up. If we just go forward, one of the key parts of this, and this obviously comes up a lot when people look at reverse mortgages and the concern around them, because this essentially kind of does operate in the same way. There's a no negative equity guarantee, which basically means that you can't borrow more money under the pension loan scheme than the security that you put up. So again, it kind of creates that or protects that negative, or protects against that negative connotation that might be associated with people borrowing against their home in retirement. Nonetheless, with obviously some of the improvements of reverse mortgage products over the last kind of 4 or 5 years. So if we go forward again, one of the things that was flagged, and this has obviously been flagged for a while now since the Aged Care Royal Commission, was an improvement in aged care and aged care responses, really. So, aged care consistently comes up in every budget, and there's a significant amount of money that's allocated in a lot of budgets to aged care. Obviously, what the Aged Care Royal Commission exposed was, it's not as simple as throwing money at the problem, that there needed to be kind of a systematic change in obviously how they assess aged care facilities, nurse to patient ratios, which obviously hasn't been kind of adopted, but was obviously flagged and highlighted. But one of the things, obviously, home care, the allocation of a considerable amount more spots to home care packages, which is around, I think they quoted around 80,000 additional home care packages over 2 years. This is really where a lot of the funds are going to be directed at in this budget and in future budgets, is the ability for people to receive care in their home. There's obviously significant waiting lists for these benefits, but the government definitely has a desire obviously keep people in care at home if they can. What they also did as well was provide just an increased subsidy around your basic daily fee that people were essentially paying at the moment. So each resident's going to get a bump of around $10 per day from the government in that respect. So just to kind of obviously take the burden off, the individual that might be in aged care. Again, as far as quality and safety goes, there'll be a new kind of star rating system that'll be associated to that across all facilities. So you can kind of have a comparison of apples for apples against the aged care quality that you are, receiving. And again, in comparing kind of apples for apples, this will apply to the workforce as well. So kind of nurses, carers coming into these facilities, they'll all be benchmarked against the same standards and essentially education standards required to do that job. And then I suppose more generally, they've flagged some new legislation and stronger governance, which will be enshrined within legislation as opposed to general standards within the industry. So, look, the reality is, aged care is going to continue to be an area of focus, as I said, in all budgets, and particularly home care. So, that's where a considerable amount of money is going. Even aged care facility royal commissions aside. So, yeah. If you just want to go forward, I might hand over to Dave here, just talk around some of the housing initiatives, as I kind of flagged at the start, which is kind of relevant for everyone with the Bank of Mum and Dad being such a huge lender now.
Awesome. Thank you, Matt. Yeah, we're in the home stretch now. So we're getting into housing. And basically, one of the big announcements is obviously the extension of the first home loan deposit scheme. So this was announced last year. Basically, for those don't know, generally when you borrow money to buy a house and you don't have the standard 20% deposit, if you want to borrow with less than that, say 10% or 5%, you have to pay what's called lender's mortgage insurance. And lender's mortgage insurance is really insurance for the bank. And it's only really insurance to the bank where if you default on the loan and the bank has to repossess the house and sell it off, if they make a loss on it, not to cover a loan, the insurance pays the difference. So it's really for them, and you pay it on behalf of the bank. The insurance is generally normally between 10 to 20 grand. So it can be quite pricey and add onto your mortgage. So what the first home loan deposit scheme, it was a scheme for 10,000 first home buyers, and basically allowed them to buy a home or borrow with a deposit of 5%. And the government would actually guarantee the difference for the lender, so there'll be no lender's mortgage insurance. So generally, what would normally happen with the Bank of Mum and Dad is if you had 5%, mum and dad would put up security for the other 10 to 15% to stop you from having to pay lender's mortgage insurance. But the government stepped in to help people come on, and they've done 2 extensions of this first home loan deposit scheme because it was very popular. The first off is the family home loan guarantee, and this is basically 10,000 guarantees over 4 financial years. And this is basically providing a guarantee for single parent families, so single parents with dependents, to buy a home with a deposit as little as 2%, which is fantastic. And the government will give a guarantee so they're not subject to lender's mortgage insurance. Now, obviously, this is subject to the banks actually providing the finance, so they still have to service the loan. So it's not just it's not a done deal. You still are going to be able to meet the mortgage repayments. So that is one of the initiatives. And then the second initiative is in regards to new home guarantee. And this is 10,000 places will be provided to first home buyers looking to build a new home or purchase a newly built home. And they'll be able to do so with a deposit, a deposit of a minimum 5%. and they won't be subject to lenders or mortgage insurances. So, so that basically previously was 10,000 places. Now you've got an extra 20,000 places on top of that, and they'll probably obviously repeat the scheme as well. So they're really expanding on that to help try and help young new home buyers get their foothold in the market.
Yeah, I might comment, Dave, that these were kind of heavily subscribed when the first initiative came out. So yeah, I mean, if you're thinking about it with your children or having the discussion, yeah, I mean, it's definitely something that's incredibly popular, and I think it's probably an initiative that we're going to see maintained over the medium term. To be honest, as housing affordability becomes more difficult to maintain while trying to grow the economy at the same time, because obviously what we're seeing is that obviously the government has a desire to grow the economy through and coming out of this recession, but maintaining house prices at a reasonable level is going to be difficult. So, yeah, I think it's a scheme that'll kind of continue for a while.
I completely agree, Matt. And look, we recommend to anyone who is considering this, recommend go see a broker, go get some advice about making sure that you can borrow the amounts. So speak to a mortgage broker beforehand, so you're well on top of it and you know what you're in for. And that sort of wraps up all the key measures from the budget. So we've done that in record time. And so next up, I guess we've got plenty of time. Does anyone have any questions?
If you just want to put them in the question box, you can type them out. That's fine. I think, as just coming back to the start and what Dave and I kind of spoke about, I think, obviously a lot of the budget initiatives get leaked prior to budget night. So we've got a kind of good feel on them. But I think as far as the more technical initiatives that came out, I think Dave and I were kind of the ilk that it was good that, it's not about a whole raft of new announcements and brand new things. It's really about looking at the framework that's already been in place at the moment and really kind of improving on it. I think there's going to be obviously still considerable challenges going forward over the next kind of 12 to 18 months. And and how obviously elections and politics play into that will probably dictate, what's kind of the next step for our next budget, really.
Absolutely right. I think one of the key things, because it's very steady as she goes, what that means is you're able to really plan effectively. As we're actually having budget at a normal time this year, as opposed to having it in the middle of spring. One of the key things is now that the budget's over, we're only 7 weeks away to 30 June. So, 7 weeks to really plan and use some of these announced measures, which have already been announced, but use them in regards to year-end planning. So with a lot of our clients, we'll be doing our year-end tax planning to help sort of manage the bill, help them get ahead and plan accordingly. So we recommend, obviously, if you're not chatting with us, feel free to give us a call and see if we can give you a helping hand to help plan for 30 June. And if there are any questions, we can.
Must have answered them all, Dave. So.
Oh no. All right. So I just want to thank Matt for his time. So I know it's been a busy few weeks for you. So thank you for taking the time out to go through and digest this with me.
No, that's fine, Dave. Thanks very much.
I wish everyone a great week. And if you have any questions, well, our details are on there. And for anyone else, you will get a recording of this and a follow-up email shortly afterwards. So thank you so much.
Thanks, guys.